Hey everybody, John Murphy with Specialty Tax and CSSI. You cost segregation work on CSSI and also offer this 263A UNICAP small business exemption deduction for with Specialty Tax. And this is for those who built a property since 2018. So this exemption or this deduction, if you will, came into play with the Tax Cuts and Jobs Act 2017. Didn't really come into play until 2022 when the IRS made a ruling that you can do automatic 3115s, so automatic change of accounting by utilizing this UNICAP small business exemption. A lot of CPAs are going to be familiar with UNICAP dealing with inventory. This is different because it has to deal with your indirect costs and some of your soft costs when you construct your own building. So this would work for if you're paying for your own tenant improvements that you're going to be using. If you're building your own building, maybe you operate some kind of a business and you're building a building for yourself. Maybe you're a dentist that's building your own office or doing some improvements to a building that you own, et cetera, to your own space. Anyway, so a lot of the different fees that you're currently paying for are expensable. And just want to make sure that you're aware of that. So we go through and we find all of that. And this is again for buildings that have been built since 2018. This is not subject to the bonus depreciation rules. You have to have owned it during the construction period. You can't utilize this and immediately sell your building. So you can't be developing it for others to sell it. So you have to use it, and it's for small business owners. So less than 30 million in gross sales, and there's kind of a scale that they start from 25 million in 2018, and in 2025 it's 30 million in sales, and you can't be a syndicate. So there's a few things to look at, but there's a lot of people that are building buildings that are doing big improvements that can benefit from this. So for example, let's say you're doing a $500,000 improvement to your building, or maybe you're building a small building, 10 to 20% of that might be able to be expensable. You'd much rather expense that than capitalize it. And of course, if you capitalize it, a lot of these indirect or soft costs get allocated, prorated, if you will, across different class lives if you're doing cost segregation on the property. So it's going to get allocated proportionally to the 5-year, 15-year, and 39-year property or 27.5-year property. So why not expense it? If it's a $50,000 expense, let's say, you get to take that in year one as an expense, not as a capitalized cost, not as bonus depreciation where you're going to have to pay the recapture tax back, but truly as an expense. You never see it again. It lowers the basis of your building. You don't have to pay recapture tax on this. For example, a $50,000 expense for you at 30%, that's $15,000. It's $17,000 tax savings for you, roughly. So why not take that? Studies don't cost a ton to do this. We do it, so you've got so it's done properly. The thing is if you miss some of these expenses by saying that, hey, I'll just figure out what my costs are that qualify for this. It doesn't take much to miss out on bigger deductions. So typically what happens is CPAs aren't super familiar with this, so they would just rather pay our firm to do it. Because the fees aren't that high to do it, and you're going to get a tremendous return on your investment. And we can do this for projects down to about $200,000. So if you're doing a $200,000 improvement, you might want to look at just having us study that and get the expenses out of there for you. So let me know, John Murphy. You can find me at costsegbuilding.com. Let's connect on LinkedIn. I'll also drop my phone number here below in the notes, and would love to chat with you about your project. Take care.